We have 4 attendees that have joined us. Hello, everyone. It is 12:30 on the dot, and we thank you all so much for being here today. I'm Tiffany Eisenhower with Freedom Property Management and Sales. We are a full-service real estate brokerage and property management firm located in Manassas, Virginia, serving all of Northern Virginia. And I'm here with Angela Gansor. Angela and I go way back, and there is no one I would rather do these sometimes awkward, mostly fun and funny webinars with. So Angela, I will allow you to introduce yourself.
Well, thank you, my kind friends. Angela Gansor with Intercoastal Mortgage, as Tiffany mentioned. So I am a senior mortgage loan officer that is mostly involved in primary residence purchasing, anything really primary residence, second homes, investment properties. I'm kind of jumping ahead of where we're going to be. Anything residential, real estate related, construction loan related, that's really our niche and wheelhouse. Like Tiffany mentioned, I have known her for a very long time, and I'm lucky to call her a very good friend of mine. So thank you for having me again today.
Yes, you are so welcome. And our focus today, we've met a couple of times on this platform and shared some information already on the basics of mortgages, the different types of loans, and sort of what's trending and what's new in the market right now. But what we wanted to focus on today is more on the investor side, and to give you some education on what the difference is between your primary residence, a secondary home, and an investment property, how you can go about getting financing to purchase or to refinance, and just kind of bringing some of this down to some very real information. So first of all, for those of us that are not in the business, we don't know the difference between a primary residence and a secondary residence and investment property. So what are those differences there?
Right. So the easy one is that most people would be familiar with, but again, just in case, we do primary residence definition. That's the residence you live in primarily. That's your home base. That's where you come and go every single day, and you are living there all of the time other than going on vacation. So that's your primary residence. So typically in a situation like that, you're going to have lower loan to value requirements. You're going to have allowance for higher debt to income ratios, and rates are typically better in that scenario because the thought process behind the risk rating being lower in that situation is that you're going to pay for where your head's sleeping every single night. So you're not going to relinquish that or not make that payment. A second home, so if you live in your primary residence here, let's just call it in Virginia, and you want to buy a second home, maybe you want to go to the lake, maybe you want a place in the mountains, maybe you want a place at the beach. What you can't have is a second home right next to your exact home, your primary residence. So that won't fly. But a second home is something that you intend to spend a decent amount of time throughout the year with. In most instances, as long as you stay there 14 days out of the calendar year, you can classify it as a second home. So that is something that we help finance as well.
Is there a minimum mileage distance from your primary residence that you need to be?
Most loan programs want you to be at least 50 miles away. Some will require 100 miles away for it to count as a second home. We've had other instances where it makes sense. Maybe we've had someone that lives out here in Prince William, Fauquier County, but maybe they work in DC. And with the demand of their job, maybe it makes more sense for them to own a property and not commute back and forth Monday through Friday or Monday through Thursday. We've had clients of that nature that will get a second home that's a condo in the city, and we can justify, so maybe that's only 30 or 40 miles, but we can justify that they are spending that amount of time in that second home and they're in their primary residence throughout the weekend. So there are unique situations.
Yeah.
But in the traditional thought, you're really thinking more destination place. I have a place in the mountains or a ski lodge, lake, or the beach. That's the easy one. So
beach would be my preference thing. So obviously with your principal residence, if you're buying or refinancing, you can have a much lower cash infusion, much lower down payments, higher loan to value. How does that differ on a secondary?
So on a secondary, we will go through ebbs and flows. I would say in the market we are right now, not all investors, but the vast majority would like to see about 20% put down.
Okay.
We had a period of time where they were a little bit more comfortable with the second homes, and they were only requiring 10% down. I'm not saying you can't find those right now, but it is much more prevalent that the investors feel more comfortable, that you have a little bit more skin in the game. So most that we are seeing right now, the pricing is falling only if you're at 20% or better. We have a few out there, but again, it makes that time for the train.
Hey, Trey.
So there, but I would just keep in your mind in most instances, 20% right now is the.
Okay. And I don't want to get too detailed on second homes. That's really not the purpose of today's topic, but since we're on it, what are on average the increase in interest rate on a secondary home versus a primary residence?
Depending on where you fall, again, there's lots of factors that go into rate calculations. I would say
it depends.
It really does. I want her to look at my rate sheet. All the little places I can stick numbers in and it spits out a rate. So it is not one size fits all. So we'll because I get that question. But it's true. Really, it is not one size fits all. We do want to ensure that we have your particulars put into that search engine to make sure we are drilling down on your specific situation. And we can play around with moving the needle in certain categories to say, well, if you did this, it benefits you by X. If I was required to give an answer, I would say it's possibly about a 0.5% difference, give or take any given scenario from your primary residence versus what you might see.
Excellent. We're not holding her.
Yes.
Nobody quote her. Awesome. So now on to an investment property.
Yep.
What classifies a property as an investment?
So a couple of different things. Investment property, you do not intend to live in it whatsoever. You are either going to buy it maybe for your child that's going to college and you want to buy a dorm down at one of the colleges and save yourself on rent. So you can certainly do that, and that would be classified as an investment property. If your neighbor's house was going on the market and you wanted to rent out that particular home, then you could purchase that as an investment property. If you wanted to purchase a condo, a townhouse, a single family somewhere in your circumference, you can certainly buy that as an investment property. So if you have the intention to allow someone else to live in there and rent from you, paying you each month to live within that residence, and you want to manage that, or call Tiffany. I recommend you call Tiffany. I'll say that again. Recommend you call Tiffany to help you manage that because it's definitely a heavier lift than you think. Or we do have more and more clients these days that are purchasing properties at the beach, in the mountains, at the lake, pick your location, and they are doing them as short-term rentals through Airbnb. So there are a vast range of options that you can do to build a real estate portfolio. It's a good investment to do other than putting all your eggs in one basket in one particular financial category.
So how many investment properties can someone have?
In the traditional Freddie Mac and Fannie Mae world, you can have up to 10 finance properties. That includes your primary residence, so really 9 finance. Now, if you own properties free and clear, that's fine. You could have 15, 20, 30 properties, but you can only at any given time have 10 finance through Freddie Mac and Fannie Mae. But wait, there's more. There's more. We also have a unique program that we'll kind of side rail from this. We have a solution. So if our client does have 10 finance properties, but they really got to have that 10th or 11th, or they have an opportunity to scoop up a handful more, we have another program that's called a DSCR program. We'll get the full definition here in a second, that you can have unlimited finance properties. It works more like a commercial loan. So I don't want to say they don't care, but they don't care. There's not any kind of constraint on how many finance properties you have with that particular program.
Love it. All right, now let's get into the nitty gritty. I know a lot of you came on to hear about, okay, well, how can I buy an investment property? How much money do I need to put down? How much money do I need to make? What's the interest rate? What is that stuff? So how can your average Joe, now if there's any Joes that are listening in, this is not intended to be you. Yeah. For your average Joe that is new to investing, new to real estate investing, what would be the best, simplest loan option for that individual to purchase their first home?
So let's take this two ways. So option number one, I know a lot of you are hanging out in your primary residence with a really sexy 2 or 3% interest rate, and you don't want to move away from it, but maybe you need a bigger house or a smaller house, but you really don't want to lose the equity that you are sitting on in your current home, but you really do need to make a life change, again, upgrade, downgrade, whatever that may be. You can depart that residence and you can go buy a new primary residence and you can rent this property out. So, and you keep your rate. So that means you are going to most likely cash flow extremely well on said property that you're departing. That will help compensate for the new rate you would obtain on a new primary mortgage. So that is an option to consider. In that instance, you obviously don't have any rental history. You've never been a landlord before or had a rental property in your portfolio. In that instance, we will either obtain a rent comp schedule on your behalf, or when you call Tiffany, she will go ahead and secure at least a 12-month lease for you and that first security deposit. And we will use that to help offset the mortgage that's currently showing on your credit report and ensure that you meet all the qualifications on the new property. So that's one avenue. Another avenue is, no, I love my house, I'm not moving, but I do want to start to buy some investment properties around town. So in most instances, again, we're going to start talking traditionally about Freddie Mac and Fannie Mae. You technically only need 20% down. However, there is a massive difference, especially currently. It's not all the time, but right in this very moment, there is a massive difference in rate and pricing for 20% versus 25% down. And when I say that, I mean the investors are basically telling us with the way they're pricing it, they want you to have more skin in the game. They want to make sure that they are in a good collateral position because, again,
lowering their risk.
Their risk is lower. The event of default is higher on an investment property. Potential default, not many people don't, but that's where their pricing and their mindset comes through. So that's an option. Again, if you're purchasing that property, we'll either get the rent comp schedule and use fair market assessed rental income to help offset the new payment, or again, we'll obtain the lease from Tiffany with the first security deposit, and it can either be first month's rent, security deposit, whichever way you draw it up, and that will help offset the new payment. So we can qualify you that way. On that particular program, you are not allowed to have any gift funds, so it has to be all of your own money somehow, some way. So that is another major piece there.
Excellent. We do have a hand raised on Zoom. Debbie, we're going to try to get you unmuted so that you can answer, or you can ask your question. Oh, maybe I can unmute you. Well, let's see real quick. Hold on. You're oh, this is why I didn't know. Nope. All right. So what I'd ask, Debbie, sorry, I can't unmute you. And if I can, I just don't know how to. If you
I'm not in charge of the IT.
Hey, I'm learning. Each of these gets better. If you wouldn't mind jotting your question down in the Q&A along the bottom of your screen. If you're in Zoom, you'll see a Q&A and you can ask a question there and we'd be happy to answer that live.
Yes, ma'am.
So, perfect. And that goes for anyone else. And I'm sorry, I did not even give that instruction when we first started. So we will definitely be happy to answer your questions live as we go through, as well as open up for a live Q&A at the end. Drop your questions down into the Q&A, into the chat, or if you're on Facebook Live, put it down in the comments. So getting back to the investment loans. If we've got our first investment property now.
Yeah.
And we're going to come back to that whole move out of your primary residence and turn that into an investment property, maybe at another webinar, because I love that strategy for building an investment portfolio. And I'd love to go through, we can do this live as a case study of how over the years you can build wealth that way.
Just a sidebar that because it's a perfect parlay and I don't want to, one with Memorial Day coming, this is actually excellent. So one, thank all of your service members who have made the ultimate sacrifice this weekend and just take a moment out for them. But I have a ton of military clients that same thing, they get transferred and transferred and transferred and transferred. So I have a very large client pool that they were stationed in Georgia and they bought a primary residence. Then they get stationed in, Kentucky, they might, and they're renting these houses, so they're constantly only buying primary residences, but they're doing the same, they're departing and they're renting. And so on their tax returns, you're going to see these multiple properties listed on their Schedule E. I am no CPA, but I do know how to read that schedule. And we have a formula that Freddie Mac and Fannie Mae require us to perform an actual rental income calculation to show if you're cash flowing positively or negatively. And that will come, again, we don't need to get sidetracked on that completely, but that's the way that we will help justify or determine what your debt to income ratio is for qualification purposes.
Gotcha. Excellent. So what would be, excuse me, the next type of loan for investors?
So the next one is the good one, guys. This is something that we are very proud that we can finally offer. It rolled out earlier this year, and you know, it's not for everyone, but it is a huge answer for a lot of people that are interested in dipping their toe into the water. This program, for especially my avid investors, and same thing if you are having an ever expanding portfolio, and sometimes the traditional mortgage lane puts some constraints on you, but there's these opportunities that you absolutely cannot pass up. It works similar to a commercial loan. So some of the residential lane that we're required to stay in kind of fades away. So we have a little bit more wiggle room. They are not going to underwrite you. They don't care what Tiffany makes a year. They don't care, you know, where Tiffany works. And they really don't care what assets you do or don't have. As long as you have a bare minimum credit score of 660 or better,
Okay.
you can buy an investment property because we are going to only underwrite the property itself. As long as the property cash flows, they will underwrite it that way, and they will leave you, Tiffany, out of the equation. Yes, you are still the borrower, or in this instance, which we can't do in the normal Freddie Mac and Fannie Mae world, you can have Tiffany LLC protect yourself.
This is huge, guys.
Huge, because again, most times when someone wants to come and buy an investment property and they want it in the name of an LLC, we get it. We get it big time. You want to protect yourself of the liability, but we can't lend to you in the name of an LLC in the residential world. Yeah, but this program blows that door wide open for us.
Excellent.
So you can borrow in the name of an LLC, have that added layer of protection. So as long as you've got at least 20% down, so again, there's that nicer niche, 20% down, you can put 25 down, but as long as you've got bare minimum 20% down, you can rock and roll with this program, and it opens a lot more doors. And they will allow, this is one thing I don't want to forget to say, they will allow for first timers. Okay, first-time investors. So if you have no history, a lot of times too, there have been phases where they really want you to have a history of being a landlord. Right. And a lot of people don't have that, or you're like, well, how do I get started? How did all these other people get into this? They, you know, somebody was the first timer at some point in their career of owning these properties. This program will allow for that. They want a little bit more down depending on the situation, but they will allow for an investor to get started.
And that's the DSCR?
DSCR, so debt service coverage ratio loan. So again, as long as the property itself cash flows, you're good.
Okay, so what does that mean?
So what does that mean? So we are going to obtain a rent comp schedule on the property and get what a current market rent is, or if the lovely Tiffany can write you up a lease agreement, then they will take the lease agreement and we'll take a portion of the lease. Okay, so it's not dollar for dollar. It's going to be a portion of the lease, typically 75%. And we're going to offset that by the principal, interest, taxes, insurance, and any condo or HOA fees. And then that will generate our debt service ratio. And as long as we're in line, deal's done.
Okay. So does it need to be a, I guess, so that ratio that you're referring to, and 75% of the rent, let's just use that. Let's say that that's our example. Right. So 75% of $1,000, you're looking at $750. So that's the max payments, including principal, interest, taxes, HOA, condo.
So we need to be just under that so we cash flow positive. We don't want to take any losses.
Okay.
So even though, again, in certain tax situations, you want to be able to show a loss, again, not a CPA, big disclaimer, not a CPA. So depending on your particular tax situation, But again, when you're purchasing this said investment property, you need it to cash flow positive. If it's negative, then they're not going to do it, you know. So we've got to make sure that it's positive out of the gate. Down the road, that's down the road. But on this particular purchase, you want it to cash flow positive for sure.
So, and how competitive are the interest rates for the DSCR loans versus your Fannie Freddie loans?
So you're going to see a difference. Again, it's a bigger risk in some instances because they're willing to open the door open to some of these other things that Freddie Mae will hold.
Got it.
You know, that guy. So you got to pay to play, basically. So it is going to work more like a commercial loan. You're going to see the higher end interest rates associated with these programs, but it gets you in, it gets you the property under your belt. It helps people that are in a tight spot of not being able to acquire the property otherwise, and we can always refinance it down the road. You know, to get you in a better rate position to cash flow even more positively, but this helps you acquire the property.
Okay, that is awesome. Love that we've got more than just your standard. You have to make the money, you have to have the history type of loans.
Right.
So we did get a question from Debbie.
Okay, good.
She asked, can you provide any short-term loans for investors, 6 months or 1 year?
So typically we do offer short-term financing in the form of a bridge loan, but that's going to be on your primary residence. So unfortunately, at this time, we're not to say never. At this time, we're not currently offering anything in investment.
Okay. Have you heard if there are any options out in the marketplace? You don't have to name names or drop that.
Right. There are always options. There's always options. And in fact, even with this program, the DSCR program that we have access to, I will confirm it, but most likely they would allow, because this one, I believe, comes with a prepayment penalty. So as long as you've made those first 6 payments, I think you're in the clear, but I will confirm that, and we can put that in comments when I get back. I knew somebody would throw me off on a question. Thank you, Debbie. I appreciate you though. So yes, we will definitely confirm that, but this could still be that potential vehicle and answer for that. There's always hard money lenders out there that you can do short-term financing, but again, you want to be real careful. There's good ones and bad ones.
I know Debbie with Security Title, she's one of our other community partners here with Freedom. So thank you for that great question, Debbie. And I know that she works with several of our local investors who do flipping, who buy and renovate and then either refi into out of the hard money into your more traditional in order to have your long-term investor or flip it for a resale. So appreciate that question. We have another question that popped up from Rebecca Witt, who's one of the realtors here with Freedom. Hey, Rebecca. Rebecca's question, would this affect the person who then later wants to turn around and buy a primary after?
So again, Rebecca, thank you. That's a great question that we pose to everyone. Your ratios on the primary residence are a lot more forgiving in most instances than they are on the investment property. So again, we would just want to ensure that you're meeting those requirements, but you have a lot more wiggle room when you're doing that, purchasing a primary residence. So no, it's not going to prevent you from buying one. It just may adjust where you land as far as purchase price, assuming all of your ratios are in line, but it shouldn't affect you massively.
So piggybacking a bit and going more in depth on Rebecca's question. So if you have rental properties and you want to buy a new primary residence, you helping to finance that new primary residence, what are the things that you're looking for to assist on the income side to offset the debt that's on those investment properties?
Right. So back to kind of that CPA conversation, we're going to take your full tax return, because ideally now, if you've had the properties for at least 12 months or longer, we like to average at least 24 months. So we're going to take your last 2 years tax returns and we're going to average. So let's just say we've got 2 years tax returns and maybe year 1 you acquired the property. So maybe there's some losses because you had to make some improvements to the property to get it where you needed and wanted it to be. And there's some acquisition costs that maybe you're able to get. So year 1 could maybe look not so hot, but year 2 looks great. So to your benefit, we're going to average the 2 years to help offset that payment. And again, if you cash flow positively, then that's great on our side. because that's more income we can leverage in your debt to income in addition to your everyday job. So that's an option. If you've had the properties for 5, 6, 7 years, again, we're going to use the most recent 2 years average income to offset. One other thing to mention on the other loan program as well is they do allow for short-term rentals. So it goes back to that Airbnb thing. They're not going to necessarily require you to have a 12-month lease like Freddie Mac and Fannie Mae. Traditionally, so it's a possibility.
Okay, so the DSCR is more forgiving and open to short-term rentals.
Right. And they will do non-warrantable condos, which is something that we have all encountered.
Yes, that's a whole topic.
Yes.
Excellent. Okay. If anyone else has any other questions, please drop them below. We've got a couple more minutes before we wrap up. So we want to make sure that we're answering all of your questions. If you've got a specific scenario, of course, we'll have the information in the webinar notes for how you can reach out to Angela directly to discuss your situation, because if you haven't already gathered, every situation is different. And so Angela's answer to a lot of questions is, well, it depends. So if getting into the investments field, buying your first or your 10th investment property is something that you're interested in, then making sure that you're current in your knowledge on what is currently available. For sure. The market's constantly changing. As Angela mentioned, that some markets you can get away with as little as a 10% down payment on an investment loan purchase.
Right.
And others, you're at a 25 to 30% in order to get to anywhere decent of an interest rate. So finding out what the current availability and information is always crucial.
It really is. It is such an ever-changing world. Even what was correct this morning might be changed by this afternoon. It's not always that drastic, but our world is constantly changing. Investors are coming in and out of the game all of the time. And so when those opportunities are there, we just want to share them with all of you so that you know when you can strike and take advantage of something. So, but yes, it's not, I promise I'm not like non-committal on answering a question. It really is very specific to each person's scenario. So just call me, we'll talk about your specific situation and find a solution.
Awesome. We do have another question come in on Zoom. Do you think rates will come down?
Oh man, the ever-burning question, my crystal ball. They will. I just don't know. Every projection we see, everything that we pay attention to, they're going to come down. It is inevitable. It's just when. I can't give you a date and time. And if I was, I'd have those money on.
Exactly. We would not be here.
Right.
We would be doing this on the beach.
At our second home.
Exactly. We would probably still be doing this because we're both workaholics. But
I wouldn't throw in the towel.
No.
Now,
but keep in mind with that, while and the Fed has indicated, you know, rates will start to come back down a bit. But don't kid yourself. We're never going to see your 2, 2.5, 3, 3.5.
Highly unlikely.
We're not going to see that again in our lifetime, not unless you're getting a 10 or 15-year loan and you're paying points.
Right. So
the time of the super duper low interest rates has passed. You're not going to time the market. If you're going to time the market and wait for rates to drop, you're never going to enter the market. So
you'll have a lot of friends entering it with you at that time once they start to dip. So your competition is going to get real fierce.
That is a great point.
The
laws of supply and demand.
Yeah,
supply and demand.
Now we'll take you to an economics lesson. Yeah, everybody else is sitting on the sidelines too, waiting for the rates to come down. So that just means the inventory is not getting any better, unless your crystal ball tells me differently. So if the inventory is not getting any better, and the second those rates drop even a smidge, they're all going to come flooding out. Now you have a ton more competition. You're better to get in now, secure it, and we will help you get a lower rate when the time comes. But then you've already secured the property. You've already been in the process of gaining equity in your.
Exactly. Debbie mentioned when she started in the title and settlements and real estate business back in the late 70s, interest rates were between 17 and 20%. So I'd love to know what the interest rate was on your first property. Angela, what was the interest rate on your first property that you purchased?
So I was lucky. I came to the table late, so. There's various reasons for that, but yes, I'm good. I came in the sun. I know, that's really like terrible to admit now that I'm good. But yes, now I will say, when I started in the business, a few weeks ago, the prime rate was 8.25. So I've seen it, I've seen all good sides, but hey, they were paying you 5.25 on your CD. And so it comes, it is, it's all relative. There's ebbs and flows. You just have to put it all in perspective and move forward. And then when the time is right for you in your particular situation, that's when you buy. You don't buy because someone else is telling you to buy. You don't buy because there's social pressure to buy. You buy when it's right for you. So as long as that payment is cool and the cash to close is cool, come on in. Other than that, don't worry about the rest.
Exactly. Awesome. Well, thank you, everyone, for joining us.
Yeah.
Angela, any parting comments?
I'm just appreciative that everyone comes and listens to us. Yeah. I love what I do. I know you do, but it can be boring stuff. So we're trying to make it fun, and yeah, we're still awkward. We're getting better at it. But thank you guys for taking the time out of your day to join us and hopefully learn something. I'd love the opportunity to chat with anybody one-on-one, again, about their particular situation. There's lots of options, so let's find a path forward for you.
Awesome. Well, thank you so much. Thank you guys all for joining us. We will have information out for our next one. If there's anything that we can do for you in the meantime, please feel free to reach out. It's always a pleasure. Have a wonderful afternoon, and please enjoy your Memorial Day weekend.
Yes.
Be safe out there, and thank those who are currently serving, and take a moment to appreciate all of those who did pay that ultimate sacrifice to give us the freedoms that we have today.
Absolutely.
Have a wonderful day.
Thank you.
We'll see y'all soon.
Bye.